10-year Treasury yield has been on a run recently, jumping more than four full percentage points over the past 3 years before briefly passing 5% for the first time since 2007. Now, if that sounds crazy, it is. In fact, the last time yields went on a run like this, it didn't end well for the U.S. economy. Joining us now, we've got Yahoo Finance's Ines Ferre to help us break this down. Ines, how did it end last time? I think we all have some idea. And ultimately, do we expect it to be different this go round?
Yeah, you have to go back to the early 80s to see this rate of change when it comes to the Treasury yield. That was during the Paul Volcker era. He was the Fed chair that went in 1979 to beat inflation. And during that time, you saw the 10-year Treasury yield go up to as much as 16%. Now, keep in mind that it was a different era because the projected GDP was much lower than it is today. But it's really the rate of change that worries so much investors. And also, by the way, in the 80s, you had a double dip recession after the yields went up so high and the rates went up so high. But just to back up for a second, when we talk about the 10-year Treasury yield, and you had mentioned it's gone up more than 4 percentage points in the last 3 years, it surpassed 5% briefly earlier this week. When we talk about that 10-year Treasury yield, we're really also talking about the cost of borrowing, because that's where you have mortgage rates that then go higher. You have loans that go higher for businesses, for governments, for consumers. So that's a concern, is that as it goes so high, then the borrowing costs go higher as well. And there's two things to keep in mind here. One is that this year, so many forecasters had said that 2023 would be the year of the bond market. You had the 10-year Treasury that started at 3.9%, and that yield has only gone higher. So it certainly humbled some forecasters that were saying that this would be the year of the bonds. But the other thing is also fiscal spending and the deficit, because the government has to fund its programs, it has to fund its spending. And as the interest rates go higher as well, when the government's borrowing money, it also has to pay higher interest. So what happens? The US Treasury then issues Treasury bonds and Treasury notes, and then that creates more supply in the market. And this is a time, by the way, when we have seen over the past year that other central banks have sort of pulled back from buying US Treasuries. Namely, there's been a lot of talk about China that's not bought as much as US Treasuries, the Fed also as well. And what this does is this exacerbates the situation, because you just have more supply in the market. And by the way, as you see also the dollar going higher, some governments are even selling treasuries in order to gain more dollars and also to protect their currency. So there is sort of a cycle that goes through all of this, but we are seeing more treasuries enter the market. As far as how far can the 10-year Treasury yield go? I mean, at 5% or close to 5%, that's a good yield. So you'd think that investors, pension funds, governments would go in on this. There is a Bloomberg report, a Bloomberg economics report, that shows that what they're forecasting is that government spending plus government borrowing plus spending also on climate change is going on. They're saying that you could see the 10-year Treasury yield go to 6%, guys.
Wow, 6%. All right. And that's something that we're going to be continuing to watch here, this massive move that we've seen most recently in the bond market and what the implications are there. Ines Ferre, thanks.
Thank you.